You only need four questions to know if an investment is solid: cost, risk, taxes, and performance. It sounds simple, right? So why do most portfolios still underperform? Because Wall Street only sells you the last one: performance. It's flashy, it's exciting, it's easy to chase. But the first three, cost, risk, and taxes, that's where the real wealth is made or lost. Before I go through the test, I'm recording this just days after Warren Buffett made news by announcing his plan at age 94 to step down as CEO of Berkshire Hathaway. He's been at it in the investing business for about 60 years now. And at age 52, his net worth was around $376 million. Today, at age 94, he grew that to $156 billion, if you can imagine that. Now, I want to make one point about that transformation, about that growth and that journey that is somewhat simple, in that how did he get from point A to point B? And one aspect of that is just a matter of math and the magic of compounding. How do you get from 376 million to 156 billion? Well, if you were to do it in 1 year, the return on that would be 39,800%. But over that 42-year span, the compounded annual growth rate on that is 15% per year. So, getting to even $376 million is a major feat at age 52, especially, 40 years ago. And so part of that was just staying alive and turning on that compounding machine and getting out of the way and not interrupting that. And he not only just compounded his money, but he compounded his human capital and his relationships. But certainly when it comes to the investments, he had a patience and a willingness to keep his eye on the long term. And as he often said, our favorite holding period is forever. And so when you are putting the compounding machine to work and you're giving it enough time to do that work and for that magic to show itself, then it is almost an inevitability that that lump sum and that amount of capital is just going to exponentially grow. And to me, that just seems like a fitting thought to have in the back of your mind as we go through this test and we evaluate what's a good investment for you, whether it's a stock or a mutual fund or an ETF or a business that you're looking to start. How do you turn on that compounding benefit and use it to your future goals? So with that, let's look at the four elements of the test and questions and things to think of as you're evaluating any investment opportunity. So in the first part of the test, and in no particular order here, but we'll start with costs, because cost is an important part of this factor. It doesn't really matter how well your investment performs, cost can be the hole at the bottom of the bucket where all the water leaks out. Some things to think about here are things like expense ratios for mutual funds or ETFs. They'll usually have that information there publicly available as part of their prospectus. And if you go to certain websites like Morningstar or other places where they publish all of the basic info around mutual funds and ETFs, that'll be something there that you can easily look up. Another thing you want to look at is the turnover ratio. And again, this is mainly with ETFs and funds. And this really just looks at how long is the money manager holding a particular stock within that fund. The higher the turnover ratio, the shorter the amount of time they're holding it, the more that they're turning over the portfolio. Now, it's measured in percentage, and it can be over 100%, meaning that they hold these particular assets for less than a year. And with expense ratios, those are also represented as a decimal point or in basis points, like with the Fed funds interest rate. So it can range from 5 basis points, which would be 0.05%, to over 1% of the investment that you have in the fund there. So those are two key ratios to look at. If you're looking at an individual stock, the cost to consider there is the share price of the company. The share price of their stock. And there you want to look at, what is the price? Another factor that's related to that is the PE ratio and seeing how expensive or cheap, is it? Compare that to historical data. If you're looking at a rental property or a business, What's the initial investment that you're going to have to put up to get into this investment, to this opportunity? What's going to be required of you now? And then what are the ongoing out-of-pocket expenses? It's easy to only think about what the upfront expense is going to be, but especially if when you have rental properties, you're going to have ongoing maintenance costs, and it's easy to overlook that. So make sure you take a look at those. And again, this isn't an exhaustive list, but that will cover the cost portion of this test. Next is taxes, something else that people don't often think about. And here you want to ask yourself, what are the tax advantages and disadvantages with this particular type of investment that you're looking at? Because different ones do have different advantages or different drawbacks. Like with real estate and partnerships, you have depreciation as a benefit where you can take a major write-off early upfront in those early years of the investment. You can take depreciation, especially on real estate, and you're going to depreciate that over time. With stocks, mutual funds or ETFs, you're going to have qualified dividends from certain companies, funds, and ETFs. You also want to ask yourself, what type of account are you using as well? And think about the tax benefits and the rules that apply to different types of accounts, whether you're talking about pre-tax accounts, Roth accounts, or after-tax brokerage accounts. Understand what the tax impact is going to be initially when you make that investment, but then also where you get income coming in along the way, and then also especially what happens when you go to sell. The third category that you want to look at is risk. And this one can be hard to conceptualize. For stocks, a lot of times people think about price volatility, which is how much is the price or the value of your investment fluctuating? Are you investing in a tech company that might have high volatility? Or are you investing in a blue chip company that's pretty stable because they're in a mature part of their life cycle? If you're looking at a business or real estate, ask yourself, how can this all go wrong? Right? It's easy to think about best case scenario. And a lot of times people get into investments prematurely because they're only looking at the positive side. They're only looking at the best case scenario. But I like what James Clear likes to suggest as a kind of a pre-mortem is what he calls it, where you write the post-mortem in advance and you just imagine the worst case scenario with this investment. How could it go wrong? And just imagine what that would look like, and then start to write out all the things that you can think of that could be potential risks, things that will derail the investment. And then one thing that you could do is put that down on a piece of paper or on a spreadsheet and make one column for the risks, and then make another column for how are you going to, mitigate each of those risks? What are steps that you can take to try to reduce or completely eliminate that risk? But finally, what liability are you taking on, especially like with rental properties where you got people in there? What type of legal liability? Because that's certainly going to play into a potential worst case scenario. So understanding that as you get into an investment. And the final category that we'll want to look at is performance. Now, of course, this is the thing that obviously you probably think of first. But when you look at the performance of whether it's a stock or a bond, mutual fund, an ETF, business, real estate, pay attention to the time frame. If you have historical data on, especially with mutual funds and ETFs, what's the time frame that you're looking at with that performance? Is it just 1 year, 3 years, 5 years, 10 years? Obviously, the more data we have, the better. Also pay attention to the calendar year returns and look at some key years like 2022 or 2020 or 2018 or 2014, years where there were major market movements, and then see, especially when it comes to mutual funds and ETFs, how did that respond? Or even stocks, how did that respond to those major moments in the economy or in the world? What happened and how did it respond to those fluctuations? So that you kind of better understand how that investment strategy works within that fund. And then ask yourself, when you're presented with this opportunity and the potential benefits, is it too good to be true? Does it just feel right? Does it pass the smell test? And you also want to check with yourself too, especially when it comes to stocks. A lot of times people have different reasons for it, but I'd say the main reason why most people, the average person, buys a stock is because they think that sucker's going up, right? And you want to ask yourself, is that why you're buying it? Or do you have another reason? Do you really understand what you're buying and what you're owning? And do you have a reasonable expectation of what it's going to look like when you own that stock or that investment over the next 1 year, 2 years, 5 years? You want to have a realistic expectation about what to expect there. So these are the four elements. Again, it's cost, taxes, risk, and performance. You don't want to just evaluate an investment only on one factor. The key here is that you're looking at all four and you're seeing how does it kind of check the box in each of these areas, and then what's kind of the sum total and the average. Is it checking off all of the boxes, none of the boxes, maybe half of them check off okay, but the other two aren't? Take a look at that and evaluate it, and before you make a decision, so that you got a really well-rounded understanding of what you're looking at. So with that, feel free to head over to my collection here on Patreon, Dream Big and Retire with Baraket. You can check out some more videos, more tips that I have here. Also down below in this post, you'll see a couple of links. One is to a weekly email that I write where I share tips like these and others, as well as things that I'm reading in the news and resources, articles, PDFs, guides, things like that, that I think will be helpful for your continued growth along your money journey. So go ahead and sign up for that. It's a short email that comes to your inbox every Friday and takes less than 5 minutes to read. The other link that you're going to see there is to my calendar where you can schedule a call with me. I'd be happy to just jump on Zoom with you and answer any questions about this or any others that you have about retirement or investing or putting your financial plan into action. As always, I thank you for your time and attention with these videos. And until next time, I want you to remember to keep putting the first things first.